What if the way your business is set up is quietly costing you thousands of dollars a year and nobody has taken the time to clearly explain why? If you're a US business owner paying serious dollars to the IRS every year, your legal structure is not just a legal decision, it can be a tax decision. This shows where we legally shrink that bill and keep more cash in your business. I'm Chris Middleton from MakeTaxesFair.com, and today we are breaking down the legal structure pillar of the Clear Edge framework and why the way your business is organized legally can change how income flows, how you pay yourself, what strategies are available, and how much tax you may be paying unnecessarily. Stick with me to the end, you'll walk away with a core understanding of the major business structures and how they impact taxes and what questions to start asking before next tax season sneaks up on you. The legal structure is the L in the Clear Edge framework, and this pillar matters because your legal structure affects more than most business owners realize. Legal structure impacts how business income is taxed, whether self-employment tax applies, whether payroll is required, how owner's compensation is handled, what fringe benefits and retirement strategies are available, how easy is it to bring on partners and investors or eventually sell. So before you chase deductions, credits, or fancy strategies, you need to answer a basic question. Is my business even structured the right way for what I'm trying to accomplish? And do I understand why I'm structured the way that I currently am? If the answer is no, you could be losing money every year, not because things are wrong, not because your CPA is bad, but because your business may not be set up to match your goals and intentions. Again, this can cost you thousands in taxes and peace of mind that you're not operating real long-term strategy in mind. Here's where a lot of confusion lies, right? Most business owners think, oh, I formed an LLC, so I'm good. Well, maybe legally, but not automatically for taxes. There's a difference between the legal entity you formed and how that entity is taxed. Now, to be clear, I'm not an attorney and we're not pretending to be one. So if you're concerned about legal liability, you need to have a conversation with an attorney. But I can tell you from a legal tax standpoint, an LLC is a legal structure under state law. But for federal tax purposes, that same business might be treated as a sole proprietor, as a disregarded entity, a partnership, an S corporation, or a C corporation. Yes, you can have an LLC that's taxed as a C corporation. That's 4 different types of tax treatment for an LLC, one legal structure. So when we talk about legal structure in the Clear Edge framework, we're not just asking, what did you file with the state? We're saying, hey, how is this business taxed? And is this the smartest fit for this stage of the business? That's the real question. So before we get too far, let's dissect the different types of business structures just a little bit. But again, I need to reiterate, I am not an attorney. I don't pretend one to be one on Zoom, TV, podcasts, etc. So that's all a joke, but in all seriousness, we're speaking in general terms here and specifically about the tax implications for each type of business entity or structure. If you are concerned about liability, I recommend you make a list of everything that you're concerned about that's keeping you up at night about liability, and then take that list to a qualified business law attorney and a qualified insurance professional. To both of those folks, I would present my list of liability concerns and say, hey, how does my legal structure, insurance coverages protect or not protect me from these liability concerns? With all that being stated, let's get back to the tax stuff, okay? So the starting point for most businesses really is what we call the sole proprietorship. This is the default for many one-owner businesses. Income flows straight to your personal return as reported on Schedule C. Sole proprietor doesn't require any registration with Secretary of State, no legal filings. You'd use your social security numbers, your tax ID. It's simple and fine when you're small, but as profits grow, more of that income becomes exposed to self-employment tax. That's not bad, but it can get expensive if nobody's looking at it, right? The single member LLC is generally the next step for many business owners. Forming an LLC can give you legal separation under state law, but by default, again, a single member LLC is taxed as a sole proprietor. So a single member LLC is called a disregarded entity. When there's one member of the LLC, the IRS says, hey, you could skip the LLC tax filing, skip that 1065 and simply report it on your Schedule C 1040. The single member LLC may be the smart move for legal purposes if you've consulted an attorney, but it doesn't automatically create tax savings. I have an LLC, so I'm set is one of the biggest myths that I see. Another myth that I see is that you have to have an LLC to claim business deductions. That's simply false. You can claim business expenses under any type of business structure you have. We'll have a future podcast episode about that topic. But right now we're going to bust the myth of I need an LLC to deduct businesses' expenses and move on. The partnership legal structure is required and common when there's more than one owner. You go from single member to more than one owner. So income flows through to the business to the partners. And the partnership can be classified as a general partnership, a limited liability partnership. And partnership structures are opted into because they can be flexible, but it can get messy without planning around the topic of who owns what, how profits are allocated, what guaranteed payments are made to partners, what qualifies as a distribution of the partner, and who is an active versus a passive partner. Some income may still be subject to self-employment tax, and a partnership structure generally does not constitute tax savings. C corporations are less of a common structure these days, but with recent law changes due to the One Big Beautiful Bill, or OB3 as I like to call it, they're starting to see some more interest in those, right? C corporations are taxed separately from the owner. That's why there's double taxation. The corporate may pay a tax on the profits, but the owner may pay a tax again when the money is distributed out as a dividend. That's the double taxation part of it. Because of the double taxation fear, many owners automatically write off C corporations, which can be a complete mistake. They can make sense in specific scenarios because C corporations can allow for heavy investment from outside parties, certain benefit planning, again, outside investors, long-term growth plays, attractive exit planning opportunities. There's a lot of benefits that a C Corp can bring. But for a lot of closely held small business, they add friction if chosen for the wrong reasons. S corporations are the entity type that everybody seems to like to talk about. So we've saved the best for last, right? In the right situation, an S corporation can create real savings mainly for this reason. Here's kind of the magic of S corps. With S corps, because some of the profit may avoid self-employment tax if the owner is paid a reasonable salary through payroll. The key words there are reasonable salary and payroll. An S corp requires payroll compliance, stronger bookkeeping, cleaner systems, and discipline. For the right business, it can be great. For the wrong business or making the election too early to be taxed as an S corp, it just adds complexity. The question is not, should I be an S corp? The right question is, does this business have the profit, consistency, systems to make an S corp the right move? And is it the right type of business to be an S corp? Fun fact, when it comes to S corporations, if you go to an attorney and say, hey, I want to create an S corp, they're going to say, cool. Do you want to be an LLC or a C corporation? Actually, a good attorney will find out about your business niche because in some states you're not allowed to be an LLC or a C corporation depending on what type of business you're in. So they'll determine what you should do for the legal formation as an LLC or C corp, and then they'll tell you should consult with your tax professional to determine when the right move would be to make the S corp election by filing the Form 2553. You see, there is no such thing as an S corp with the legal formation. You create an LLC or a C corporation and then make an election to be taxed as an S corporation with the IRS. The bottom line is this: your legal structure should follow strategy, not hype. There are nuances and complexities that apply to each type of legal structure, and those decisions should be made with careful consideration and educational background for you to understand why that thing is being done. Your legal structure affects how much tax hits the owner personally as a flow-through, whether payroll and payroll taxes come into play, again, how you pay yourself through owner draws, wages, guaranteed payments, what benefits and retirement options are attractive and available to use, how easily your structure can evolve as you grow. It's harder to do it with some types of entities than others. That's why legal structure in the Clear Edge framework directly connects to the other Clear Edge pillars of employees, retirement planning, deduction optimization, exit planning, and efficiency. One decision touches a lot of the systems, and it comes back to your legal foundation. If your legal foundation is not optimized, many other strategies underperform. Here are some of the biggest mistakes I see business owners make when it comes to their legal structure. 1, they assume an LLC automatically saves taxes. 2, they elect the S corporation status too early before profits and systems justify it. Staying as a sole proprietor or default LLC long after profits have grown. Copying another owner's structure without understanding why it works or doesn't work for them. choosing once and never revisiting the structure as your business changes and evolves. The best legal structure for taxes at $80,000 profit may not be your best structure at $500,000 in profit. Your legal structure is not just a checkbox on a tick on a to-do list, right? You don't just check it once and move on. It's a tax strategy decision that should be revisited occasionally and discussed. The way your business is organized affects, again, how income is taxed, how you pay yourself, what planning opportunities you can or can't use, and how much money may be leaking out unnecessarily. There is no one best entity for everyone. Anybody that says, oh, you should be an S Corp and that's it, maybe, maybe not. The best structure depends on profit level, number of owners you have, growth plans, administrative capacity, compensation strategy, your long-term goals. So instead of asking what entity is best, what legal structure is best, you should start asking what structure is best for my business at this stage with my goals. That's the better question to ask. That's the legal structure pillar of the Clear Edge framework. In this episode, we've just kind of gone over the high level. The goal is to own a business that's structured intentionally. So the next time you think about taxes, don't just ask, what can I write off? Ask, is this business even built on the right foundation? And that's how you start making strategic moves. If this episode helped you see even one way how your structure might be affecting your taxes, again, just don't nod and move on, right? That's how you continue to overpay the government year after year after year. Go to maketaxesfair.com/podcast to get the show notes for this episode and the free resource that we've created for you. We put together a high-level guide to help you think through the major entity type options and the key tax questions to ask before you assume that your structure is just fine. Again, that's maketaxesfair.com/podcast. And we like to say that friends don't let friends overpay the government. So if you found this episode valuable today, we ask you to share it with a friend, and we'll see you next time. I'm Chris Middleton with Make Taxes Fair. Thanks as always for being here. Catch you in the next episode.